While the focus is on a potential government shutdown, my next guest says historically, geopolitical risk has actually been conducive to growth, productivity, and asset returns overall. So it's not a risk. It may actually be an opportunity. Joining me now is Marko Papic. He's the macro and geopolitical strategist over at BCA Research. This is a perfect conversation to have right now, Marko, because we've just now heard the update from Megan with regard to trade and tariffs, the update from Emily with regard to the government shutdown. Just how worried should the markets be this time around? It doesn't, by the way, seem like they're that worried at all.
No, and I think that the reason that the market is not worried is that bond yields have been steadily coming down since the one big beautiful bill was passed. Now, my controversial view that very few of your viewers are going to agree with is that the one big beautiful bill, if you account for tariff revenue, is not that really profligate. And so the bond market calmed down. And I do think that the relationship between yields and equities is really all that you need to focus on. If yields continue to go down to 4, then 375, things are going to be fine. Equity markets can go higher. The problem with tariffs, of course, is that if they're made illegal and if President Trump then struggles to find other reasons to keep them in place, the bond market has to have a different approach to pricing one big beautiful bill, because then it is profligate and then yields should rise, and that would be a problem for the U.S. economy and also for equities.
It hasn't happened so far. How critical is that tariff conversation, that tariff ruling, if we want to look at it that way, to whether or not yields actually have the ability to move lower, to your point, to that 4% threshold for the 10-year or even lower than that? And how important is that yield story to continuing the stock market rally?
I think it's the only story, quite frankly. Bonds and equities have been positively correlated really since 2020. Fiscal policy, inflation, these have all upended the correlations from the secular stagnation era. And so right now, for the economy to avoid a recession, we need the consumer to transition from a cash-driven world to one of leverage. And that requires borrowing costs to come down. The Fed can't do it on its own. And so this focus on whether the Fed is going to cut or not is kind of irrelevant. What's required is a long end of the curve to be satiated with a sane fiscal policy. And that's where the conversation you had with your colleagues on government shutdown is also very important. So that's what's really required. And I think without a lowering of the long end of the yield curve, you're not going to have equities do well. So I think it is crucial. But I'm also hopeful that, ironically, tariff revenue will stay there. And I say ironically because, again, in April, we were all very bearish because of tariffs. But now the U.S. needs that revenue. Otherwise, bond market will punish it the way they're punishing France, for example, today.
All right. So that long story, sovereign wealth-wise across the world, sovereign bond-wise across the world, is still in play. My question then for you to conclude things, Marko, is given that backdrop, is the U.S. still the best place to invest? What is the best trade right now globally?
Oh, no, absolutely. It's probably the worst place to invest. So your viewers have to understand U.S. equities can go up. In fact, countries that have lost central bank independence have done great in equities. Look at Argentina's or Turkish equities over the last 25 years. They've crushed it. However, the currency is going to suffer. So from a relative perspective, if you're a U.S.-based investor, you should be seeking external non-U.S. equity markets because it gives you non-U.S. dollar exposure. So no, U.S. markets are not the best place to invest. Absolutely not.